So the age-old debates, higher time frame versus lower time frame, swing trading versus scalping, which one is better? So I myself have been trading for almost a decade now, and I've done it all, I've seen it all, I've tried it all, and I've studied it all. And if you go through my journey, you will see I was predominantly a higher time frame swing trader. And if you go back on this channel's history, you will see those videos where I'm doing higher time frame analysis, those very high risk reward positions. However, as the years have gone on, and especially in the last 3 years, I've become super focused, specialized, and niche in the lower time frame, specifically intraday and intra-session trading. So why did I make such a stark difference? Why did I transition my way of trading from swing trading and higher time frame basis all the way down to what would be considered scalping by some, which is focusing on intra-session volatility? So in this video, I'm going to do a complete breakdown on why I think the lower time frame, why I think intra-session trading is far superior compared to the higher time frame swing trading. And because I've done it both, because I've been profitable in both, I'm going to give my lessons and my experiences and why I think the lower time frame is key. Well, the first thing to develop is the difference between risk to reward ratio, which we all hear about, but more importantly than risk to reward ratio is your return on investment. How much did you actually gain in your account, realized profit after taking the trade with that 1% risk? Therefore, to say ROI is more important than RR. Return on investment is more important than risk to reward. And it's easy for the online gurus and the marketers to simply only throw the risk to reward ratio. And that's something I was always careful of, because that can be quite misleading, because I think it would be very foolish to be holding a trade 1 to 20 risk to reward and not take a partial. That means you have 20% unrealized profit and you're hoping to gain another 10% to get 1 to 30. So you're risking that 20% going all the way back to break even simply to gain another 10%. That is a negative risk to reward. You're risking 20% of unrealized profit to potentially gain 10%. That negative risk to reward is the pitfall of high risk to reward trading that don't talk about taking partials. Partials are essential. So in my whole journey, when I've been documenting online, whether I was doing high risk to reward swing trading or the risk to reward models I do now, fixed protocols on intra-session volatility, I always clarify return on investment. So that brings me to point number one. If you are a higher time frame trader, if you are a swing trader, if you are a fundamentals trader, naturally you will catch more pips. You will go for the bigger moves. And if you are competent enough to still have a small stop loss, which is very achievable, as you've seen in my public signals, a 3 to 7 pip stop loss consistently is very achievable. Therefore, a higher risk to reward ratio on your trade analysis, on your trading view, the tool you put where the risk versus the reward, that tool can be a very high risk reward ratio. However, the return on investments, well, that's something you need to focus on, because if you're only taking profit at the final TP, at the final level, you leave so much money on the table of unrealized profit. For example, if you're running 1 to 10 and you don't take a partial and that comes to break even, it's easy to say, oh, well, I didn't take a loss. But the reality is that's a huge inefficiency in a trading system over the course of a year. How much percent are you leaving on the table because you don't take partials at the right time? So when I was doing swing trading, I always took partials in sensible ways. When I was selling, for example, at an intraday structure point, let's say a M15 lower low, that's when I'll take my first partial. And then maybe the 4-hour lower low, I would take the second partial. And then the final partial at a daily lower low. So that 1 to 30 risk reward on TradingView, that actually might realize as a 7% gain. And of course, it depends position to position and how you exactly manage it. But 1 to 30 did not mean 30%. 1 to 30 meant 10%. 7%, maybe 12%. And that's great. That's phenomenal return. For a funded account, you could make a lot of money. You could pass an evaluation in a single trade. And I've seen a lot of traders. I've spoken to a lot of traders on my podcast, Titans of Tomorrow. I've spoken to some of the best traders in the world, traders who've done over $1 million in payouts from prop firms. And some of them would also be using higher time frame and swing trading backed by heavy fundamentals. So it's definitely a profitable approach. But I do not believe it's an optimal approach. When it comes to the spinning plates analogy I give, where we have to optimize all of the plates, you know, the guy in the circus that has to spin many plates and he can't let one of them fall. Well, if you focus on the risk to reward plate, yes, you can spin that plate. But what happens? Maybe your win rate gets really low. Maybe your break-evens, the amount of break-even trades and the money you leave on the table becomes suboptimal. Maybe your trade frequency is very, very low because you have to wait for these huge swing trades to play out. High time frame aligned prime setups, they are not going to be every single day. So there's always going to be trade-offs. So you can compensate for that and say, let me add fundamentals. Let me add in more currency pairs to trade. There's always ways to combat it to have the spinning plate equilibrium. But the question still remains, is it a worthwhile trade-off? Is it beneficial to be swing trading, or should we actually only focus on the lower time frame and optimize for intra-session volatility? So let me present a full case study for you. Let me present all of the things to consider apart from risk to reward, apart from the payouts we see people doing from your favorite mentor and such. Let's do a objective, unbiased analysis on what is truly better: higher time frame swing trading or lower time frame intra-session trading. So the first key point on why I believe lower time frame intra-session trading is far superior, having done both, it is my thoughts and belief that higher time frame swing traders don't go into full detail. Now, what I mean by that is they'll see the daily time frame, they'll pick a daily point of interest, a daily support level, a daily trend line, and they'll base their entry and analysis based on the higher time frame. Obviously, the higher time frame is more stable, more solid. Maybe you add in some fundamental biases, and now you stick to the basics. Trend is your friend, higher time frame zones. And what does that lead to? It leads to an idea of daily trends, so that will take days and days, weeks, even months at times to play out. Swing positions. You can catch a big move, you can catch a big trend, you get a big mammoth trade, a big meaty trade that might be 200 pips, 300 pips. So you're catching a big move, the bulk of the big move, and you're following a higher time frame stable trend. So a lot of things logically align. But mistake number one I see is traders take the higher time frame analysis, higher time frame zone, higher time frame trend, and they also enter on the higher time frame. The idea being a daily time frame trend needs a daily time frame entry. And I think that's a huge inefficiency and a huge mistake, because let me tell you, when I was swing trading, that's where I started. But then I went deeper and I thought, why can't I enter on the M15 and hold the trade for a daily swing on the daily bearish market, for example? So I take a daily point of interest, a daily supply zone. I know it's going to be bearish to make a lower low compared to the trend, but instead of entering on the daily zone and having a 40 pip stop loss, why not reduce that? So what people start to do is they'll start to use patterns, candlestick patterns, and they'll say, instead of waiting for the whole zone, why not wait for a doji candle and put the stop loss at the high? So I thought, okay, now you've reduced a 40 pip stop loss down to the candlestick pattern. That might be 20 pips instead. So you've automatically boosted confirmation and you've boosted the risk to reward. Now, the reason you should refine your entries is for two reasons. You want more confirmations, so you refine it further, and then you want a better risk to reward, so you refine it further. So there is significant benefits of looking for lower time frame confirmations and refined entries. So I started to do that. And I started to look at candlestick patterns. I started to investigate 4-hour patterns. Then I started to look at M15 patterns. And it took me on a journey to realize the market is fractal. Whatever happens on the higher time frame happens on the lower time frame. The market is fractal. The market does not move with time. Time frame is not a vehicle for price. Time frame is how we as traders package price to visualize it. So when I started to go lower and lower and lower, I started to realize, yes, I can get further precision, I can get further accuracy, I can get a better risk to reward, I can get a better win rate because I see the confirmations of a zone about to fail or is going to respect. So there was significant benefit in hybridizing things. The mistake number one swing traders make is saying daily trend means daily entry. Rather, we should actually seek to go lower and lower time frame to find a hybrid model where it's precision based on the lower time frame combined with a higher time frame outcome, combined with the swing trading perspective. That's where my journey took me, and that birthed the high risk reward trading that you saw me do for years. Swing trading is not about the entry or the exit. Some people would define it and say swing trading is how long you hold the trade. Whether you hold a trade for a few hours, that's intra-session, a few days, that's intraday trading, or a few weeks, that's swing trading. So depending on how long you hold the trade duration defines if it's swing or scalp or intra-session. I think that's not quite correct. Second of all, people base it on the entry. They say, okay, if it's an entry based on a lower time frame, it has to be an intra-session trade. And if you take the trade based on daily time frame, that means it's a higher time frame swing trade. Again, I don't think it's so correct. We have to take things a level further and look beyond what we see online on the internet. I think swing trading truly means is you catch the bigger portion of an overall trend. That trend is usually a day-to-day trend. It's not an intra-session trend. It's a trend that lasts for days or even weeks at a time. A 4-hour trend, a daily trend, even a weekly time frame trend. These are going to be your swing time frame trends. Now, what are we going to mirror that with? We can mirror that with higher time frame structural points, higher time frame POIs, and higher time frame trend. But what are all these reflections of? These are all reflections of fundamental consensus. Whether the euro is stronger than the dollar based on geopolitical factors, based on the economy, based on macroeconomics, based on inflation, interest rates, and the overall health of an economy versus another. That's what's going to drive the market on that higher time frame. That's not what drives the market on a session-to-session basis. There's other things that are more important than fundamentals on intra-session versus a swing trading perspective. So therefore, to say the correct way to view the markets from a swing versus intra-session is swing trading is going to be looking at the major moves, fundamentally fundamentally aligned, higher time frame trend, but we could still use lower time frame entries and we could still have high risk reward. Those traders that are doing higher time frame swing trading with fundamentals and they have a 1 to 2 or 1 to 3 risk reward, I feel like there's a huge inefficiency in there because there's no reason any trader should have a 50 pip stop loss. Regardless of if you're swing trading and higher time frame aligned or scalping and intra-session trading, there is knowledge and virtue and clarity and significant benefits in going down to the lower time frame for entries. It'll improve your win rate, it'll improve your precision and accuracy, and it'll improve your overall risk reward. Now, whether you hold the trade for days or weeks using fundamentals and using higher time frame trend, or you're just holding it for the session volatility, that 1 minute time frame mastery is essential regardless of what trader type you are. And that's where my journey took me in my first 5 years. So taking a look at this example that I've randomly drawn, let's assume this is the daily time frame. So if we do some basic analysis, we can see that we have a bearish market where we have lower highs, lower lows, lower highs, and lower lows. So we've established a bearish market structure. Then within that, we can register the POIs. So let's say the lower high that made the lower low, that is going to be our favorable supply zone that price retraces to. And then we can add certain things. For example, we can see this compression, this buildup of liquidity that does a run of liquidity over here, that inducement that leads to large imbalances, large momentum, and a bearish lower low. And then we can see the retracement is very, very slow compared to the impulse. And we can read within there, we have sub-cycles of buildup, inducement, mitigation. Then we can see the same thing happening again, buildup, inducement, mitigating the previous on the left, pushing out. Random drawings, but this is how the market is obviously going to move. Buildups and inducements and so forth, and mitigations. And then we can see when price starts to arrive to our supply zone, what would the higher time frame trader do? They would say, okay, I'm going to wait for a candlestick pattern. I'm going to wait for just the support level to form. I'm going to wait for the higher time frame order block, the higher time frame supply zone. And therefore, they're just going to enter based on a higher time frame perspective like this. And let's say they enter like that. They enter on the whole zone, the whole supply zone on the daily time frame. That might be 30, 40, 50 pips. And then they're going for a new lower low. So they'll still get a 1 to 5 or 1 to 7 risk reward, a 1 to 4. These are what these higher time frame swing traders based on fundamentals are going to be achieving. High strike rates, let's say, because you're relying on higher time frame solid zones. But again, the trade duration is going to be days and days or weeks and weeks. And your return on investments is not going to be crazy. Because you can achieve this while you take and hold for weeks. You can also achieve it in the space of a few hours if you focus on intra-session. This base level of higher time frame swing trading alone, I don't think is the most effective because we can bring that stop loss down significantly. And a way you could do that is going for intra-session understanding. Let's say you have your Asia range over here. Then you have your smart money traders seeing these equal highs. You know how smart money traders love that. And then you see that run of liquidity candle smart money traders going to enter on. Let's say we have a smart money trap right there. And then we have London Open over here, mitigating the extreme of the supply because we know that this was a build-up and inducement. So now we refine the supply zone from the whole daily level all the way down to a refined area on, let's say, M15. And then we see a daily cycle variance within it where we have Asia high, smart money trap, time window, lower time frame model. And instead of entering on the daily time frame, you can enter like this on the intra-session perspective. Based on the two-leg protocol, time window, daily cycle variance, inducement cycle variance, structure cycle variance, all of these things you've seen me speak about at length, the primary drivers, the laws of the market. You can now take a lower time frame based entry and still hold it for a swing perspective, make that lower low. Now your risk reward is going to be significantly better because your stop loss went from, let's say, 50 or 40 pips down to 5 pips. And you're holding the trade for the same duration. So your risk reward goes up, your precision is improved because you're entering at the exact moment of confirmed reversal, and your win rate is going to be better because you potentially can recognize on the lower time frame when this higher time frame zone is going to fail, when this higher time frame zone is going to get induced, and then give the entry model. You can see these on the daily cycle variance and lower time frame model. How can a higher time frame swing trader know if their daily supply zone is going to fail and is going to do a major inducement and then go down? What usually they do is they add a buffer. They say, I'm going to take my supply zone and add on 15 pips. So meaning you compensate for a lack of knowledge or a lack of precision with a random buffer. Now that will further worsen your risk reward, and it doesn't really solve the problem. It just throws a buffer on it and hope for the best. That's not what a real precise trader should be doing. Rather, you wait for the confirmation. You wait for the confirmation if the zone is going to respect or if it's going to induce the supply zone, and then you enter with precision and you have a higher risk reward. That's exactly what I was doing from year 3 to year 5 of my trading. I was doing this for a long time. I was profitable at that point, but there were still certain problems. For example, for me to achieve these high risk reward trades, these 1 to 30, 1 to 50 now, based on lower time frame entry, higher time frame bias to hold the trade for a long time, the problem became the opportunity cost, the rate of return. For example, a trade like this might take days and days or even weeks to play out. So yes, I would have a high risk reward, but my return on investment wasn't the best because I would obviously take partials at an intra-session level, maybe at an M15 level, let's say an M15 lower low or a liquidity target. Then I'd wait for the 4-hour shift or maybe even the whole daily shift. When you have these certain areas to take profit, Obviously, there's suboptimal ways and optimal ways to do it. And maybe on certain days you take it based on Asia low and you realize that's too early. So you wait for the 4-hour low and that's where you take your first partial and you realize that's too far away. So depending on the case, you might be nailing your take profit levels. Other times you might totally get it wrong and suboptimally manage a position. So your return on investment, despite the pip count, despite the risk reward ratio, you might only get 7 to 10% gain. But as you know, you can do that on an intra-session perspective with session volatility. You can very quickly get 1 to 10 risk rewards on a single day. You've seen me do it in these case studies. You've seen me do it in my public signals where I did 10% in a single day, 18% in a single day on live market callouts. That's not often, that's not every day, but it's certainly possible. And your rate of return, your rate of growth is going to be significantly better. And that's something to consider. An equity curve that's slowly growing like this, or a linear equity curve that's slowly growing like this. I would prefer the second, the faster growth. Not about exponential parabolic growth, just linear growth at a faster rate. Another thing I started to realize was what happens if price comes towards my target, my final TP, and then reverses on me. And then we get a new trend forming and now we enter a bullish market. Maybe I took a partial, but I didn't fully close out the whole position because I was hoping for a lower low. Meaning to say roadmaps become significant because the market doesn't just go from A to B. The market goes from A to B in various ways. M15 structure, M15 liquidity, daily cycle variance, H4 structure, all these new conditions plus new geopolitical factors. How likely is that the bearish market you're looking for that might take weeks to present? What if things change in the economy? What if a war begins? What if Donald Trump or Elon Musk starts to tweet? All of these things have a factor in the market. So what you saw on the day of entry might be completely different just 5 days later. You have to be aware that what you see from market structure, what you see from higher time frame supply zones is not going to be permanent, and you might get a small reaction and then it fails on you. You might get price go half the way to your target and then new things change, new structure comes in, manipulations, all these things are a significant contribution. And it's not a case of negligence. You can be fully competent in your higher time frame. You can be fully competent in your market structure read. But as each day presents, new factors come into the market, new considerations happen, new information leads to new outcomes, leads to new price action, and that can completely invalidate your trade a few days later after getting in. And this is something I experienced and it was frustrating. And I would cope and comfort myself by saying, at least it wasn't a loss. But this is a huge inefficiency in a system that we do have to absolve because we can't be running a trade for 10 days and we might be running 1 to 20 risk to reward and only lock in a few percentage and leave all of that money on the table and waste all of that time. Much rather we go to an intra-session model where we know very quickly we're right or wrong. We know in the same day if we are right or wrong, and we are not subject to changes in the market that naturally happen as day to day unfolds. So that is point number 2. We have to be aware of all of the roadmaps that allows price to go from A to B on a higher time frame, and we have to realize that it doesn't always hold. The higher time frame is not be all and end all. Obviously things can change. Higher time frame structures can fail. Higher time frame POIs can fail. So we have to be aware of all of these things, and then it becomes about your rate of growth. I'd rather get a 6.5% gain in a single session, which you've seen me do countless times because I have a fixed partial protocol system. At 1 to 3 risk to reward, I take 50% of my volume. At 1 to 10 risk to reward, I cap it and take full volume, and I don't worry about the rest of the trade because I know more often I'm more likely to get these smaller pip count gains, more concrete than these higher pip count gains, which are not so solid and not so reliable. So why try and get a 20% or 15% gain over the space of a few weeks when you can lock in 6% gain in a single session, or even if you don't get TP2, at least 1.5% gain on a very frequent basis because we're just optimizing for 15 pips. And when you focus on the lower time frame, you start to realize it's really hard to know where the rest of the month is going to go. No matter how good your fundamental analysis or technical analysis may be, no matter how professional of a trader you are, knowing where the rest of the month is going to go is hard. But knowing where the rest of the session is going to go is a lot easier, is a lot more reliable, because it's just liquidity pool to liquidity pool. It's session volatility, time-based manipulation to liquidity target. It's intra-session trends. These things are so much more reliable and they're not subject to the higher time frame. They're not subject to fundamental changes because you're just holding the trade for a few hours. So knowing where the rest of the day is going to go is far easier. And if you're going to trade with a lower time frame confirmation sets, which I think is imperative, then you can still get a high risk reward on an intra-session perspective. So why not do that? And rather trying to hold the volume for these big RR trades, take partials early and be okay with that, because I can tell you with confidence, because I've seen it, I've shown it so many times. If you can get time-based manipulation correct, aligned with a higher time frame zone at the key moments of a daily cycle, let's say a London Open with session volatility, if you can find cause and effect, meaning manipulation, inducement, and then follow through to the next liquidity pool, it's very easy to catch 15 pips during a London Open, the most volatile moments of the day. With a lower time frame entry of 3 to 7 pip stop loss, you can get a 1 to 3 risk to reward in a single session. Even in a single hour, it can happen so easily, or you hit break even or stop loss very quickly. And I'd rather know what my trade is going to do fast, so I'm not stuck in drawdown for a few days. How many times does a swing trader have to sit in consolidation at their entry for a few days, or see price go 50% to their target and then face a retracement of a week and hold that drawdown, hold that retracement, and not take irrational, emotional based decisions? I would rather know very quickly if I'm right or wrong, not have to sit in drawdown for days, not have to have a huge retracement and think about it for days and days. It removes emotions. And there's been so many times on my public signals where I've given a trade, it hits the 1 to 3 target, just 10-15 pips, and then reverses on me, and the rest of the volume is break even. In fact, out of the 60% gain that I've publicly given, I think around 35 to 40% of that public gain has been from just the 1 to 3 partials, meaning just 15 pips. Knowing where 15 pips is going to go, that's able to contribute to a significant account growth. And what could that do for your life? What could that do for you if you were a funded trader and you had $500,000 in funding and you were able to do 30-40% in the space of 6 months? Just by knowing where session volatility is going to go, just by knowing how to get a 5 pip stop loss and a 15 pip gain. On GBPUSD in a London session, in a London Open, you're telling me you can't get a 15 pip gain? Of course you can. If you focus on manipulation, daily cycles, inducements, session volatility, all of these things that I've spoken about at length on the channel, it's so possible. I want to open your eyes to it. Now, I know a lot of people come online and say M1 is noise, M1 time frame is for the gurus and the lifestyle marketers and all these things. And of course I see that. Of course I agree. But that's why I come with receipts. That's why I come with proof, concrete proof that no one can deny. The live call outs, the case studies, the consistency in the trade types. Doing this for almost a decade, I can speak with complete transparency, complete authenticity, and complete truth. The lower time frame is the way. M1 mastery is the way. M1 is going to reveal so much clarity in the market, avoid so many unnecessary losses, improve your precision, improve your risk reward, improve your peace of mind and therefore psychology, because you're not focusing on days and days in drawdown, huge retracements that last for weeks, and the emotional roller coasters of not knowing if your trade is going to hit final take profit after holding it for 2 weeks. All of these things I experienced, these are scars and traumas I hold, and I want to give you the wisdom and the lessons without the hardship. And I'm telling you for a fact, lower time frame brings better trading, better precision, better peace of mind. Why wouldn't you? Why would you be ignorant to say lower time frame doesn't work? There's so much clarity, there's so much detail. You have to use the lower time frame. Now, whether you align the lower time frame with the higher time frame, I support that. Whether you align the lower time frame with swing trading, I support that. I think that you could be optimal by taking stronger partials earlier and locking in more volume, more percentage, because risk reward ratio versus return on investment are different things. So if I can lock in 7% gain in a day versus 7% gain in a month, I would rather do that in a day, because then I have another opportunity maybe just 2-3 days later. So think about these things. When we optimize the system, we don't optimize it for price action. We don't optimize it for risk reward. We optimize it for overall growth, longevity, precision, accuracy, adherence, rate of return. These are all things to consider. So if you can optimize the system for the most volatile moment of the day, with the most meaningful moves of the day, with the session volatility on your side, with the tide of the inducement of the day you're trading away from, if you can optimize for lower time frame confirmations and daily cycles, so you have a higher risk to reward and a higher win rate because you're focusing on precision, you align it with a higher time frame zone, your trade duration is just a few hours, so your emotions are not going to be there in the same way. There's so many benefits, but let me remind you of the cons as well, because you're going to find out very quickly if you're right or wrong, and that can be an emotional roller coaster. If you enter a trade and within 10 minutes you're out, that's something to adjust to. Getting competent on the 1 minute time frame, because it does move fast, it requires a bit of experience, but to gain that experience doesn't take years. I think you can get competent in the space of a few weeks or months if you know what you're doing and knowing exactly what to look for, and if you have correct guidance. If you're focusing on the lower time frame, you might take more losses in a week, but then you have to have a strike system. You have to have protocols in place. You have to say, I'm not going to trade 10 currency pairs. I'm going to trade 1 or 2. I'm not going to trade every hour of the day. I'm going to focus on 2 hours of the day. I'm not going to take 20 trades in a week. I'll restrict myself to 5 trades a week and be selective. I'm going to break down my trading system into trade models. So now I'm going to have my A+ setups, my A setups, my B+, my B setups, and I know when to deploy them. So on a new account, on a funded challenge, I start off with my A+ setups. If I have a 10% buffer, if I've had a win rate, I can now afford to have my B+ setups come into the market. If I'm on a losing period, retrace, now stick to A+ setups. So you should know how to deploy them, because you want to go for high risk reward, yes, but you want a high win rate at the beginning, and you want to, in a controlled way, lower your win rate so you can start to increase your trade frequency to capitalize on rate of return, to capitalize on the high risk reward you can do. So there's so many ways to operate a system. We should not be binary and say higher time frame versus lower time frame, or swing trading versus scalping. We should be holistic and view all things, and all things considered. My approach and belief is you need to hybridize things with lower time frame model entries, time-based manipulation, displacement as a key, imbalances as a key, time of day as a key, daily cycle as a key, higher time frame analysis. Higher time frame zones are always better. Intraday trend is going to help. Fundamentals and swing trading approaches are going to help, but if you combine everything and you don't optimize for a 200 pip gain, you optimize for the session volatility and you take partials accordingly in an optimized approach for data, as I've explained, these things are always going to be superior. And of course, I've had conversations with great swing traders, great higher time frame traders, great fundamental traders, and it's not to take anything away from that. It's simply to say, in my experience, in my opinion, there's better ways to do it, and I've given evidence, explanations, proof, track record, everything I can to break these limiting beliefs of all of the people you hear online saying only focus on the higher time frame, only focus on trend lines and support and resistance and Fibonacci's and all these things. There's keys to the market, and I want you to unlock and see what's behind that door, because there's so much precision, so much money to be made, so much success awaits if you just know exactly what you're doing. But again, the key to all of this will always remain in the fact that a restricted trader is a profitable trader.